Hi friends, Professor Joe here. I hope you all are doing great. Now, I have over a decade of experience in trading, in Forex, and in stock markets. All these videos that I'm creating is out of my own experience and learnings in the markets. In this video, we are going to understand what is a moving average and how it can be used in your trading. So let us see how to go ahead and use moving averages. So in this video, we are going to cover a few topics. Those are: what is a moving average? Why is it called a lagging indicator? How is moving average used? How do you trade with a single moving average trading strategy? How do you use moving average crossover strategy? How do you use dynamic support and resistance strategy? And there is a surprise tip at the end of the video. So kindly watch the video till the end to get the surprise tip. But what is more important is you learn how to use moving averages in your day-to-day trading. Now, what is a moving average? A moving average is basically a line that you see on the chart, a line that is either going upwards or a line that is going downwards, or sometimes it is zigzag on the chart. That's basically a moving average. Sometimes the candles are very, very noisy. When the market moves up and down very, very quickly, the market is volatile, then it becomes difficult to identify the trend. In such cases, moving averages help the traders and investors to identify the trend. A moving average is basically created out of the previous data. So, however, the market has moved previously, the moving average is formed according to that. A trader and an investor can have multiple options in moving average. You can use 5 moving average, you can use 10 moving average, you can use 50 moving average, you can use 200 moving average, you can use 400 moving average. 5 means 5 data points are used. 15 means 15 data points are used. 200 means 200 data points are used, and 400 means 400 data points are used. The more data points when used, the moving average is more stable. That is why a lot of traders prefer 200 MA, because that is giving data of previous 200 candles. So it's a very, very strong indicator while you're trading. Now, since the moving average uses previous data, that is the reason it is called as a lagging indicator, because the data used to create a moving average is from the previous candles. The moving averages will surely show us the trend basis the previous information, but it can never predict the future movements of the market. Basically, there are multiple types of moving average. One is an SMA, which is a simple moving average. Second is an EMA, exponential moving average. And then there are smoothened moving average, weighted average moving average, linear weighted moving average. So there are different kinds of moving average. But most of the time, traders and investors use either an SMA or an EMA. Now, what is the major difference between an SMA and an EMA? So SMA gives equal weightage to all the data from the previous candles, whereas EMA gives more weightage to the latest movements, that is the previous candles. So if a trader or an investor is purely trading basis moving average, they would prefer an EMA because it is showing the movements of the latest candles. So, for example, if the moving average is slowly going upward and if one candle fall down quickly, the moving average will quickly turn its direction. Whereas SMA is giving equal weightage to all the candles, so it might take a couple more candles before it would change its direction. So for quick movements, you can use EMA, that is exponential moving average. Now, most of the time, I personally use exponential moving average, but it depends from trader to trader or investor to investor, which moving average they want to use. There are not much difference in it, but still, if you're doing an intraday trading or scalping, then it surely makes some difference. So getting a moving average on a chart is very, very easy. Towards the end of this video, we will surely look in trading view how to get a moving average onto your chart. Now, these are simple trading strategies that are used using moving averages. The first strategy is when the price is below the moving average, you only look for sell. So there is only one moving average, as you can see in this chart. And when the price is going down, and when the price is below the moving average, the trader will only look for sell opportunities. And as you can see in this chart, there is only single moving average. When the price is above the moving average, the trader or the investor will only look for buying opportunities. The next type of trading strategy is the crossover trading strategy. Like you can see in the chart, there are two moving averages. One is a smaller time frame and one is a higher time frame. Now it can be multiple combinations. It can be 10 EMA and 20 EMA, 50 EMA and 100 EMA, 100 EMA, 200 EMA. Whatever you prefer, you can use. As long as you are able to understand the charts properly after putting these moving averages, you should go ahead and use these moving averages. Now in this case, we have used 50 and 100. So like you can see, when the 50 EMA crosses the 100 EMA from above going down, then the trader will look for sell opportunities. When the 50 EMA crosses the 100 EMA below going up, then in that case, the trader will look for buying opportunities. The third type of strategy that a trader and investor use is called as dynamic support and resistance. So how does a trader use dynamic support and resistance? So first, the trader will wait for the crossover to happen. So like you can see, the blue MA has crossed the red MA from top going down. Now the trader will wait for the price to come back in between the blue and the red EMA. Once the price comes in between that, then only the trader will execute the sell. And in the case of a buy, first the trader will wait for the crossover to happen. Then the trader will wait for the price to retrace in between both the moving averages, and then they will execute the buy call. So this is how they will use dynamic support and resistance. Now the next type of trading strategy using moving averages using long term and short term. So for the long term, the trader or the investor will look for a 100 EMA or a 200 EMA or maybe a 400 EMA. And for a short term, the trader will use maybe 10 and 20 EMA. So number one rule is the price has to be below the long-term EMA. And then when the short-term EMA, that is a shorter EMA, crosses the longer EMA within the short term towards the downside, like you can see on this chart, then the trader or the investor will execute a sell call. And in the case of a buy, the trader will look for the price to go above the long-term EMA, and then the shorter EMAs has to cross each other, and then the trader will enter into a buy call, like you can see in this chart. So the trader is using multiple EMAs to enter the trade. The next type of strategy is basically an investor strategy, where an investor will always wait. So when we are talking about investor, we are purely talking about buying in the stock market. So the investor will wait for an accumulation to happen. That is basically the price is accumulating in one area. And then when the price breaks a 200 EMA, then the investor will enter into that particular stock. Some investors will not exit. Some investors do exit when the stock price comes below the 200 EMA. It depends from investors to investor. So like you can see, there are multiple ways an EMA or an MA can be used. Now let us look how to draw an EMA or an MA on a chart using TradingView. So like you can see on the screen that we are using Euro USD chart. It's a daily chart and we are on TradingView. All you have to do is go to indicators and type in EMA. So there are multiple types of EMA. We will use the simple one, EMA, moving average. Once you enter EMA, normally the standard default EMA is 9 EMA. Now to change it, you just have to go to the settings and you can change the length to 10, 20, whatever. Say example, you go with 25 and you press OK. You can see the EMA has become a 25 EMA. So this is a single EMA. You want to add another EMA, you go to indicators, you press exponential EMA, and then you add again as default. You can see the 9 EMA has come. You can change it to say 12. And if you want, you can change the color because earlier one was blue, so you can change it to red. And you have to press OK. So there you go. You have got two EMAs. One is the 10 is 12 is the red one, and 25 is the blue one. And you can see the crossovers happening. And this is how you can put an EMA onto your chart. But the best thing is the gift. The best thing is the offer that I told you all. So that is basically the dynamic support and resistance. So you can go to indicators and directly click onto dynamic support and resistance. So you will get a long-term trend indicator and the short-term trend indicator. So when it is showing red, that means the trend is down. When it is showing green, the trend is upward. But when do you enter the market? You enter the market when the shorter time frames, the candlestick is above the shorter time frame. Now the shorter time frame over here is 20 and 50, as you can see over here, and the long time frame is 200. So you can change the shorter time frame from 20 and 50 to you can make it to 20 and 10. There you go. So it's 20 and 10. So every time the price is above the 20 and 10, you can trade for a buy, or if you're looking at a weekly chart or a monthly chart, you can invest for a buy. So this is the bonus tip which I told you I will be sharing. So in summary, what have we learned? We have learned what is a moving average, how to use a moving average, why moving average is called a lagging indicator, what are the type of moving averages, which one you should use, what are the different strategies in moving averages, and using a moving average is all dependent on the experience that a trader has. The more you use it, the more time you spend with it, and the more you are able to understand which moving average is best for a particular stock or for a forex currency pair, you will keep getting better at it. I hope that this video has made it clear how to use a moving average and why it is used. Now, friends, I have written a book, Traders You Can Win, but First Learn to Lose. This book is more for traders, for intraday, swing trading, and even long-term trading, because this speaks a lot about all technical side of the trading. I have explained moving averages in detail in this book. So if you're interested to buy this book, you will get it in Amazon. It is available in Kindle. Now, if you like the video that I am creating, please like and share this video so that other people who want to understand moving average can learn how to use moving average and use it in their day-to-day trading or investing. And for more such videos on Forex, stocks, cryptocurrency, please subscribe to my channel. All I can say is keep learning, keep growing. Thank you. Namaskar.